Let's now look at example number 29. All right, this is continuation of taxable temporary differences only. So let's look at example number 29. Financial assets which are carried at fair value and which exceeds cost, but no equivalent adjustment is made for tax purposes. All right, let us say I purchased investment in equity shares of Reliance. I purchased investment in equity shares of Reliance at, let us say, rupees 75,000. I have purchased shares which are worth 75,000. Now, as per Ind AS 109, those shares have to be measured at fair value. I have to measure those shares at fair value. So fair value, let us say, is actually equal to rupees 90,000. All right. On my balance sheet date, the fair value is equal to rupees 90,000, which means that I will actually be showing 90,000 on my balance sheet. Whatever is the fair value, that will be shown on the balance sheet. The 15,000 is what I would have recognized as a gain. 15,000 I would have recognized as a gain in the P&L account. Now, if you think of it over here, if I start plotting the carrying amount of the asset, the carrying amount of the asset is going to be equal to rupees 90,000, because 90,000 is the fair value. This is the amount that I'm going to show on the balance sheet. So the carrying amount of the asset will actually be equal to 90,000 rupees. The second step will be calculating the tax base of this asset. Now, tax base is the amount that will be allowed as a deduction in future. Now, let us say when I actually sell these shares in future, if I sell these shares in future as part of capital gains calculation, the cost of acquisition will actually be allowed as a deduction. What is the cost of acquisition in my case? The cost of acquisition is going to be equal to 75,000. Therefore, I am going to have a temporary difference of rupees 15,000. I'm going to have a temporary difference of 15,000, and this represents my future taxable profit. All right. If my expected future sale proceeds is 90,000, against that, I'm going to have a 75,000 deduction. Therefore, my future profit is equal to 15,000, on which I basically recognize a deferred tax liability. All right. So that was with regards to first point under example number 29. Let's move to second point under example number 29. An entity revalues a property, plant, and equipment under the revaluation model treatment in Ind AS 16, but no equivalent adjustment is made for tax purposes. All right, we actually saw an example also for this. If you recall, let us say we actually had the carrying amount of the machine. Let's say we had the carrying amount of machine as rupees 1 lakh. All right, let's say we have the carrying amount of machine as rupees 1 lakh, and hypothetically, let us also assume that WDV of the machine as per tax books, the WDV of machine as per tax is also equal to 1 lakh. As per tax, also, let us say it is equal to rupees 1 lakh. All right, so the carrying amount and WDV are actually equal. Let us say I'm now revaluing this machine upwards. I'm revaluing this machine upwards, and let us say I am revaluing it to 1,50,000. I'm revaluing it to 1,50,000. All right, we had discussed that the journal entry at that point would be machine debit of 50,000 to revaluation gain, which is a part of OCI. Revaluation gain is a part of other comprehensive income, and we recognize this revaluation gain of 50,000 in other comprehensive income. Now, after this, my carrying amount of the machine is going to be equal to 1,50,000. My carrying amount of the machine will be equal to 1,50,000. It was 1 lakh originally. It was 1 lakh originally. I have increased it by 15,000. Therefore, the carrying amount is going to be 1,50,000. The tax base is going to be the amount that will be allowed as a deduction in future for tax purposes. I will continue to get a deduction only of rupees 1 lakh for tax purposes. Just because I revalued it in my books of accounts does not mean that I will actually have a higher deduction for tax purposes also. So the amount of deduction that I will get in future, whatever is the WDV of the machine, that basically represents the amount that we will get as a deduction in future in the form of depreciation. So the tax base will actually be equal to 1 lakh, and therefore my temporary difference will be equal to rupees 50,000. 50,000, the temporary difference is going to be equal to rupees 50,000, which is in the nature of taxable temporary difference. And on this, I'm going to have a deferred tax liability. All right, I'm repeating myself. Let us hypothetically consider a case where the carrying amount and WDV of the machine as per books, carrying amount as per accounting, and WDV as per tax are both actually equal at 1 lakh rupees. As per Ind AS 16, I'm revaluing the machine upwards by 50,000. I'm revaluing it from 1 lakh to 1 lakh 50,000. As a result, my carrying amount of the machine increases. Now, just because I've revalued it for accounting purposes, will I actually be able to claim a higher depreciation under tax? The answer is no. Tax will still continue to give me the depreciation as per my cost itself, as per my original cost. All right, now the WDV over here is 1 lakh rupees, which means the future depreciation deduction that I will get for tax purposes is 1 lakh rupees. Whatever is the WDV, that basically represents my future tax deduction. Therefore, I am going to actually have a tax base of 1 lakh, and therefore my temporary difference will actually be equal to 50,000 rupees. My temporary difference is going to be equal to 50,000 rupees, which is a taxable temporary difference on which I will recognize a deferred tax liability. All right, so that is with regards to example number 29. These are two cases where we're having a deferred tax liability or a taxable temporary difference as a result of fair value adjustment. As a result of fair value adjustment or revaluation, we're actually having a taxable temporary difference. With that, we're done with example number 29.